Hi, everyone. I hope you're having a wonderful week. It seems that we're on and it's working on every platform, so we'll get going for the week. So this week we have the great privilege. We're going to be joined by Tim Jackson, who's a fellow entrepreneur, venture capitalist, and intellectual who's had a myriad and interesting life story, and I'll let him share it shortly. And he just wrote a book on frankly lessons he's learned along the way, and especially coaching a lot of CEOs and founders. And so the book is named 36 Lessons from Company Founders and CEOs, and it'll be interesting to hear what it's all about. So without further ado, we'll get the week started. So welcome to Playing with Unicorns, episode 18, 36 Lessons from Company Founders and CEOs with Tim Jackson. So, Tim, thank you for joining us this week.
Hey Fabrice, it's lovely to see you again. It's been a while.
It has been a while. I mean, it's actually funny because if you think about it, we've actually known each other probably for like 22 or 23 years. And especially in the early days, our lives were very interconnected and intertwined. Maybe you can start by giving us a little bit of your background.
That's right. Well, you'll talk about the intertwining, but my background is basically, I suppose I've done four different things. I started out when I graduated college as a journalist. I worked for The Economist and the Financial Times in London and Tokyo and Brussels and Palo Alto and Berkeley, and I wrote some books. And I then became an entrepreneur. The last journalistic job I did was writing a column for the FT about web business models. And in fact, somebody from the Financial Times the other day sent me a column that I wrote about Amazon the week that they opened up, because I just called and spoke to Jeff Bezos. And the post after the IPO of my company, which was on the Nasdaq and in the first internet bubble, those were exciting times for both of us. I became a venture capitalist. The Carlyle Group, which was then I think the world's number two largest private equity firm, had raised $750 million and decided it wanted to do venture in Europe. So I joined them as a managing director and spent a couple of happy years watching the elephants learn to dance as PE firms tried to come to terms with what venture is all about. I then spent some time running a charitable foundation, but found myself getting kind of sucked back in to early stage investing. Because interestingly, even when you send people emails saying, no, I will not read your slides and no, I will not take a meeting, the deals don't stop coming. And I realized that actually my heart is with the struggling entrepreneur who's got a fantastic business that isn't yet quite right. And that was really the sort of genesis of what became, what kind of grew out of a micro family office into Walking Ventures, which is a seed stage tech venture fund, very early stage, very, very small tickets, current of investments in 50 some companies. And that's been kind of fun because the returns are great. Not quite as brilliant as yours, I would guess, Fabrice, but we have something like an 8x multiple of invested capital. And the news over the last couple of years is that I've increasingly been asked by next stage VCs to help them out with portfolio companies that we didn't seed, that we're not an investor in. And that's why I now spend approximately 20% of my time coaching CEOs. And that doesn't just mean CEOs that I'm working with because we own a stake in their company. It means CEOs where I'm just an advisor to the CEO with the mission of trying to help them increase shareholder value.
That's great. And what led you though to write a book? Is it like you felt that people were making the same mistakes over and over again, and that needed to be shared?
Well, first of all, it's kind of fun. And, I'd written three books before. And I lived in Silicon Valley for the first time because I was writing a book about Intel. And it was fascinating to discover how Intel was this kind of Catherine wheel of talent. Dozens and dozens of brilliant people got their first jobs at Intel and then quit in order to start their own companies. But I think that my own experiences as a CEO were that I knew some things and there were an awful lot of things I didn't know. And it never crossed my mind to ask my VC investors if they could recommend someone who could help me get better at the job of being a CEO. And as a result, I was kind of like someone who's a really not playing a driving game where I crashed into the barriers a huge number of times, still managed. And it struck me that I've noticed with lots of the CEOs that we've backed that actually many of them have got great talents, but also have got some gaps, and that there's not that much available to help them sort out what they need to do.
Do you think most founders would have the humility to say, okay, I don't know everything. I'm going to read a book and I'm going to learn things from other people's mistakes versus like making their own mistakes?
Well, frankly, no. And I think that the reason that it came in a book is because I found myself writing quite regularly on Medium and elsewhere about the kind of challenges that I was observing CEOs facing. And these things are, and so basically, the title that you quoted, 36 Lessons from CEOs and Founders, is in fact the subtitle. The main title of the book is Startup. It's about what are the issues in building startups. And actually, the way the book is kind of architected is not something that you have to sit down with on a rainy afternoon and read from cover to cover. The idea is that it addresses 36 different questions. How do you do this? How do you do that? And that very often CEOs who don't plan to take a month off from their day job in order to learn more about their own professional development may still have problems that they want to solve. And the book kind of is a way of helping them solve problems.
Actually, taking a step back, because it's probably for fun and for the audience to talk about how our lives were intertwined. I mean, you built a company called QXL in the UK, which was basically an eBay copy or adaptation for the UK and Europe, which is kind of what I was doing as well in France with a company called Auckland. And the funny thing is, originally my company was going to be called Alibaba, but then there was this guy in China that bought this Alibaba.com domain and refused to sell it to me for 10K. And so I bought the name called OLX, and which stood for online exchange. And your company, which was Quixel originally, QUIXELL or something like that, you renamed it like QXL literally the week before I was launching. And I was like, wait a minute, QXL OLX. They're like you can't tell them apart. I'm not even sure you know that story, but I was like, you can tell them apart. So I was like, okay, I have to rename. And so I put OLX in the back pocket, last minute found Auckland and launched Auckland. And then ultimately, I mean, your company bought mine. And in fact, the entire tech platform of our company started running yours. So we became really intertwined.
Yeah, that's exactly right. And I have to tell you, I'm an extremely useful resource for entrepreneurs on the subject of company names. Because basically, if I think a name is good, that is an unerring indication that they should not use it. And if I dislike a name, then that probably means it's quite promising. The thing is that the company name QXL is truly appalling. And I can't even think why I chose it. What I can tell you is that one of my team pointed out that the domain bid.com was available and that maybe we should consider buying that. And I said, that's a pretty good idea. Let me think about it. I thought about it for about a week, by which time it was too late. So, yes, I cannot claim any expertise in picking good names. But I think you're right. And that Fabrice, I think one of the things that both of us learned, as it were, in the first wave of the internet was that there was initially huge skepticism. Lots and lots of people said, hey, this stuff will never catch on. Yeah. The number of VCs that I met who said, what makes you think people will buy stuff online in Europe was truly astounding. And then, of course, it flipped very quickly from ignorance or fear at the one end to greed at the other, when prices and valuations were a bit crazy, and the pressure from investors was just to acquire customers at any cost. And it took quite a while for that to shake out to a more realistic understanding that unit economics do matter.
It's actually funny that it also reflipped again. Like in 2001, after the bubble burst, the internet was dead. Like no one wanted to fund anything. Like the people, the people, I don't know who those people are, but clearly the consensus was, okay, the internet thing, it's been tried, it's done. Clearly the pets.com and Webvan and all the telcos, they've all gone under. It's going to be this small little niche thing. Really, that was the consensus. Like the same people that were essentially faxing me binding term sheets and people I never met before a year earlier would not even return a call to like consider investing in the next startup. I mean, it's interesting how quickly these things can change.
And I think there's going to be a very interesting discussion for us to have about what we expect over the next couple of years. I have to confess that I've predicted, 7 out of the last 3 recessions, and so I'm a little bit of a doomsayer on this. But I see markets as being pretty fully valued, and I see lots of entrepreneurial behaviors that that feel like bull market behaviors. But we can come back to that.
Yeah, we'll come back to that. I mean, I agree. I think we're in a full-on bubble, and not just, and I don't mean tech. I mean everything, like public
Right.
market equities, bonds, real estate outside of major cities, etc. Um, just for fun anecdote, I mean, I assume the reason your VC is called Walking VC is because you like having walks with founders and CEOs and potential entrepreneurs that you back as a means of like getting your neurons started. I mean, I remember many of our famous walks.
Well, it's funny. There's actually 2 reasons, and you're right. You've correctly identified the first one. And what I discovered only after I had got in the habit of taking lots of walks around Kensington Gardens and Hyde Park in central London is first that you can have a slightly different conversation with somebody when you're not facing them across a table inside a conference room, which can feel slightly more confrontational, slightly more negotiating in style. And when you're walking alongside somebody and you've got the visual distractions of not tripping over the stuff that you're walking past, that's kind of helpful in allowing people to have a kind of more personal conversation. And I had concluded, looking back on our investment successes and failures, that I had underweighted founder skills and founder temperament as a factor in our investment decision making. And I thought that therefore it would be a good idea to move up the process of due diligence a bit closer to the top of the funnel, actually meeting entrepreneurs and learning about their life stories as opposed to hearing their pitches. This is not at all about, I'm going to make you show me your slides as you walk around the park. There was one guy who actually turned up to the meeting point with his hand kind of outstretched like this and a notebook computer sitting on top of his hand, which he was ready to open up and start showing slides because he thought that's what this was all about. No, on the contrary, it was just about learning people's stories. And I find that actually people are very different when you're chatting to them over a walk
Mm.
than when you're in an office and when one side is trying to intimidate the other with its power and its prestige. But there's a second thing too, which was that I think it's a cliche often spoken by middle-aged venture capitalists that building a startup isn't a sprint, it's a marathon. And yet, what I know from all the middle-aged VCs I know is that their definition of a marathon is typically 3 months to 6 months of training, 3 hours of running like hell, and then a week in bed as they recover. And I think that actually very few startups are fast enough and lucky enough to be a kind of 2 to 3 year gig. Um, and my company was pretty fortunate in terms of its timing in that it was 3 years from a standing start to a Nasdaq IPO. The exit, which by today's standards was tiny at just under $2 billion, happened to take another 7 years. But that was the time to IPO. Now, I think therefore that if you're looking for an analogy for what it's about to build a startup, instead of speaking about marathons, it's probably a good idea to speak about walking. And the reason I say this is because I realized after a little while of doing a couple of walks, one at 9 a.m. and one at 8 a.m. every weekday with founders, that I was covering the same ground as the equivalent of, roughly speaking, 3 marathons every 2 weeks. And yet I never raised a sweat. And what I realized from this experience is a bit like that line of Peter Thiel's that people overestimate what they can achieve in a year and underestimate what they can achieve in a decade. So also, if you just get up in the morning and walk for a couple of hours every morning, you cover an awful lot of ground. I got the badge from Fitbit for walking from the top of Africa to the bottom, and then I got the badge for circumnavigating the globe, and then they ran out of badges. Um, and the thing that's striking about it is that actually, if you're running a startup, patience and being willing to just keep showing up and keep trying stuff is incredibly important. And I think, therefore, that when you're thinking about a name for the kind of entrepreneurs that you're willing to back, it's not a bad one.
It's a very good point. The thing is, there's a fine line to toe between grit and tenacity and the willing to like every day to keep walking and eating glass, etc., and knowing when to call it quits. and knowing when, like, you're beating a dead horse and you actually should move on either from an idea or a specific startup.
I think that's,
Wait one
but
second.
we
The
don't want.
internet disconnected. So you said something, and it's no longer streaming. So when you said that's so true, we're going to restart. Give me
Right.
two
Okay.
seconds. As soon as it starts, we're reconnected. Okay, I think we're good again.
So, chapter in the book.
Okay, no, go for it.
Yeah, sure. I think that's very true. And the point is that um, the one of the chapters in my book is about when to give up. And the paradox is that we as investors want entrepreneurs who are crazy enough to be willing to declare that the rest of the world is wrong and that their vision of how the future ought to be is the correct one. But we don't want them to be so crazy that they will continue to pursue that vision after endless repeated pieces of evidence that in fact they were mistaken. And so there's a fine line to walk if you're an entrepreneur. How many times do you keep flogging the dead horse before you say, time to move on and do something different?
And what's your answer?
Well, I don't think it's about a number of. I don't think it's about a number of times. I think it's about how much validation you have about real demand for your product. And this ties into, I think, another paradox of typically Series A companies. It's surprisingly common for VCs who see some signs of early product traction and early customer traction to give, between $2 and $10 million to some founders and say, "Come on, go for it."
Yeah.
And very often, the dynamic at board meetings, which I see because I'm often observing board meetings with CEOs that I'm coaching, um, is that the less skilled VC investors want to see top line growth, and they often don't scrape away with their fingernails beneath the surface to understand how much real acceptance there is for this product, how much need is there for the product, and that often shows itself in terms of very inefficient marketing
Yeah, no,
metrics.
you could totally get top line growth if you want to spend money in marketing. I mean, the well known example, if I give you, if for every dollar you give me, I give you back $2, I think we're going to have a super high top line growth, but the unit economics are never going to work. And I think most founders would do better to like figure out product market fit and make sure the unit economics work before putting the pedal to the metal. But I think often you're right. There's a lot of pressure from VCs for just show the growth no matter what. And
That's right.
yeah,
But here's a tough question for you, Fabrice. Of the companies you see, what percentage would you say are spending too heavily on marketing before getting product market fit? And what percentage have achieved product market fit but are being too conservative on their marketing spend?
the for the most, the thing is we are so unit economic driven. So for us, the people come to us once they already they can articulate a story, even though it's seed and they're doing 100K a month, of what their unit economics look like and what their CAC looks like, and if the unit economics are underwater, the why they're going to get there with either scale or further experimentation. So we don't actually have much of that problem because we're also not the you must grow at all costs and grow from 0 to a billion in revenues in the next few years. But I suspect, and especially in the West Coast, that most VCs are pushing people to grow a lot. We're spending the problem is more the former, meaning people are spending way too much money in marketing when they're not ready to scale than they should. And the fact that people who have figured out unit economics not spending enough is a much smaller problem.
I think that's exactly right, and that we at Walking Ventures have exactly the same preferences as you guys do, which is if somebody comes with very impressive top line growth numbers, but it's clear on looking a little closer that the unit economics suck, then we're not going to be a potential investor for them. However, in markets like the ones we've been seeing over the last year or two, there's plenty of people who are willing to do that.
Yeah, and by the
And
way, as a result, we probably miss a lot, perhaps the very best companies, because some of the very best companies didn't have any unit economics. I mean, you think of Facebook, Airbnb, the early days, Google, frankly, they didn't even have business models, let alone unit economics, or Uber. For a long, long time, their unit economics are underwater, and so it begs the question as to whether or not that it is actually the correct strategy. Um, Yeah, I think we disconnected again. But what I wonder or worry about is because of the power law in venture, where the very best companies account for all the returns, and some of the very, very best companies don't really even have business models, but they just have like growth, and people would like keep piling in on that growth. Do we miss on those companies as a result of requiring our unit economics? And are we perhaps the ones that are mistaken? Because clearly I I I passed on like everything. I mean, I wasn't always seeing them, but I would have passed on Facebook. I would have passed on Google. I passed on Uber reasonably early because the unit economics were completely underwater. I mean, they were losing as much per month as they had in net revenues. Uh, you know, and same thing for Airbnb. And yet ultimately those would have been the highest returns I'd ever made had I made those investments. So I don't know if you've actually
Well,
questioned that.
well, so, yeah, I've got a
Yeah.
thought on this. I think I think there's different categories of uneconomic. So, for example, one category is we're simply not yet at a scale where we're going to get
Hmm.
revenues. So, a good example is that Facebook, for example, is a valuable property precisely because of the micro targeting opportunities that arise from knowing absolutely everything about all their users. And that isn't something that's valuable when you have 100,000 users at all. And it's only slightly valuable when you've got a
But
million
the
or 10
interesting thing
million.
is
It
they could
becomes
not. They didn't articulate that early. They were not articulating. I don't think they knew that either. How much value there would be.
Well, in a way, that's why I find that the deal memo that was written inside Sequoia and subsequently
Mm.
published about their investment in YouTube really interesting, because essentially what they did was they looked at YouTube. They said it's got three competitors in the video on the web space, which was extremely nascent at the time. And if you look at this chart, said the deal memo, it's like 7 8 pages. You can see that they're growing dramatically faster than everybody else, and that it will not be very long before they have a clearly dominant position. I think the hypothesis is even if nobody's paying today to advertise against video on the internet, if you believe that both internet usage will spread across the population of the world and also that hours online per week per person will increase, it's not a very difficult stretch to say, well, we can see that there is an established business model in network
Sure.
television and that people who spend time watching stuff are willing to put up with some ads. And so I think if I had had the privilege to be offered YouTube, I might have taken it. Now turning to Uber, I think that's a third and different example, which is that obviously there's some businesses where there's a huge pump priming issue that the Uber service itself is not valuable if I have to wait 17 minutes for a car. And it will only become valuable if they are willing to pay drivers to sit around until they solve the chicken and egg problem. And so that means that when you open an Uber type service in a new city, you've got very heavy losses at the beginning as you get to the point of having critical mass and a reasonable number of people on both sides of the marketplace. Um, but then I think there's a further and different category of not having good economics, which is actually just where you've got strong unit economics on a per transaction basis, but you've just got really heavy central costs and you don't have enough transactions yet to amortize those central
Oh,
costs.
that one I don't worry at all.
I,
That one I know
yeah,
you. As long as you show you can scale, that one is not an issue.
well, yeah, but it is interesting how many people don't see that the more conservative investors are unable to
Hmm.
separate the two. And they'll look at it and say, oh my God, you're burning huge amounts of money without realizing that the tiny but very fast growing number of transactions are all unit economics positive. So you're right. I mean, I think it's subtle and it's difficult, and it's easy to make mistakes and miss things.
So maybe switching gears on like lessons learned. Maybe we can help some founders and CEOs not make all the mistakes that we made, and that frankly most of the founders in our teams keep making over and over again. Um, how do you bucket the errors, and at what times do people face different errors? I mean, obviously there are 36 but I think you've bucketed them in groups like co-founders and top teams, culture, etc. Like, how do you think about it? Like,
Yeah,
what's your
exactly. Yeah.
personal framework?
I think of it in terms of macro, medium, and micro. So issues to do with the company as a whole, interesting, which for example might include
Hmm.
culture, um, or might include, for example, fundraising. Issues to do with your team, which might include things like, when I say your team, I mean the people who report to you, which would include things like hiring and firing and dealing with co founders and figuring out how to do effective one on ones. and issues with yourself, which are to do with how to make effective use of your time and how to get good resources and how to focus on what's most important. I think if I were to pick out one thing as an example, um, I think many founders, especially young founders, have not had a lot of experience of managing other people. And very often they can veer to two ends of a spectrum. At one end is the micromanagement end, particularly those who've started businesses where they've hired individual people, individual contributors to do specific jobs, where those people require quite close management. Let me look at the designs you've done for the homepage, and I'll send you back iterations on them. And at the other end, kind of neglect, where I've got a problem, I'll hire somebody, and I hope I won't ever need to talk to them again, and they will just solve it for me. And as companies grow and start raising funding, it's fairly common for young founders to hire in senior people at the instigation of their VCs, and it's a valuable thing to do because you often need experience and skills in order to build a business. But then to think, well, this VP sales has got 10 years more experience than I have in doing sales, so I think I can just basically leave her to get on with it. And that is very rarely a recipe for success. And I think that what I see among the most successful CEOs is an ability to strike a balance between neglect and micromanagement, and to find a way in which they can regularly engage with the 3 to 6 people who report to them and help them do the
Is
best
there a
job they
best
can.
practice, like check in once a week, more than once a week, less than once a week, or is it depends on the position, it depends on the circumstances, or like if I was like starting and I was like 25 and I had like these direct reports 35 and they're much better than me in marketing and finance and sales, what would your recommendation be for me to how I should interact with
So,
them?
so I think there isn't a best practice in terms of frequency, because it varies exactly as you say on the people and the context and the type of business. But I would say there's a commonest practice, which is that what I see most commonly in startups is that CEOs are having one-on-one sessions with the people who report to them roughly
Yep.
weekly. Some of them are having sessions with some of them roughly every second week. Now, the difficult bit is that it's often the least effective CEOs who are just not talking to people, who are either not talking to the people who report to them very often at all, or they're speaking to them 17 times a day. And the effects of not speaking to them at all are obvious. The drawbacks of the 17 times a day interaction are that actually you end up, if you're the founder CEO, making all the decisions for your CTO or for your VP sales, because every time something comes up, they lean across the table at you and say, hey, what should I do about this? What do you think? And then you end up, without intending to, disempowering them. So I think the key issue is, how can you support them without doing that? And even though I can't say there's a best practice in terms of time, I think there are some best practices in terms of content and what you discuss and how.
Okay.
And I came up with an acronym after observing lots of successful CEOs, which is the word SCRIM. And to sum it up, I think that there are basically 5 things you need to do if you're a CEO and you're having a one-on-one with somebody, and your objective is to help them and make sure they're doing the best job that they can. And this is common to all managers and people who report to them. So what are the jobs that a manager has to do? Well, number one is you have to make sure that the people who are reporting to you are suitable. That's the S of SCRIM. If you've got somebody who's clearly in the wrong job or clearly not up to it, then there's a limit to how much time you can spend trying to train them and improve them. And actually, you need to recognize you've made a hiring mistake. So checking for suitability is crucially important. Second thing is that if you've got shed loads of money, then you will hire people who've done everything in the job before that they need to do. And that will be expensive, but it will also be slightly unfulfilling for them because they won't learn anything on the job. If you're a more tightly funded startup, then one of the things that you'll want to be doing is hiring people who've got lots of potential but haven't always done everything. And that therefore means that your responsibility is that they come in with lots of skills and knowledge, but you have to coach them a little to be able to do the job that's required in this particular company, in this particular context. The third thing is that it's all very well for someone who reports to you to know what to do. The question is, are they doing it regularly? And so to go back, for example, to the case of sales, if you've got somebody who's a VP sales, one of the common requirements of running a sales team is that you have to be in regular contact with the salespeople, and you have to be evaluating what they're doing and keeping them enthused and so on. And if you're not doing that at the required frequency, then you're not reliably executing on those skills that you have. There's also an issue, and this is probably the eye of Scrim, about involvement and incentivization. That if you've got half a dozen people reporting to you, it's your job to make sure that they feel excited about coming into work and excited about what they're doing, and they feel a shared sense of destiny with the success of the company. You don't want them to feel, oh, well, if this startup fails, not my problem, I'll just go and get another job. And it's a crucial part of the job of every manager, and that goes right the way up to CEO, to know who's engaged and who's happy and who's not, and how to fix those problems, and to figure out what are the drivers that will make people happy. Obviously, doubling salary never hurts. Giving people a wad of stock options is great, but there's a lot of stuff you can do that doesn't simply come with money, that makes people more motivated and give more of themselves. And then the final thing, the M of Scrim, is actually just about metrics. That it's very valuable to know what are the quantitative measures that tell me whether this person is doing a good job and how well things are going this week versus last week. And my sense is that a CEO who touches all those bases in a conversation with a report is unlikely to go too far wrong.
Okay.
Because that's covering kind of the key stuff that you need to do if you've got somebody reporting to you who you are managing.
I mean, that sounds like good best practice for how to manage a team of people reporting to you, what be they very experienced or not very experienced. Is that the main thing that leads companies to fail? I mean, I guess companies fail for a million reasons, like the co-founders fight, they don't find product market fit, they're bored, they fight with their board, they fail to raise the next funding, or like, do you have a hierarchy of like, is this like near the top, or is just one of the important, or is it all those things are required for things to lead to succeed, and so it's more like a checklist of like keeping everything like going?
Yes, it reminds me a bit of the first sentence of Anna Karenina, which I think is all happy families are alike, but each unhappy family is unhappy in its own way. I think that the lesson from this is perhaps that if you look at startups that are really succeeding and founders and CEOs that are doing a fantastic job, they're much more similar than those who are failing. They often have very different preferences and habits, because often, for example, there are CEOs who love to be the kind of outside person and who are not interested in operations. And what they want to do is go around the world evangelizing and enthusing people and arguing for their company and their product. And they need somebody else to mind the store. And there are other people who are, perhaps more introvert and more quantitative, and who love to just stay in the office, not talk to anybody, and make sure that everything is optimized to the nth degree. So there's a range there. But in terms of failings, I think that it's very hard to produce a pie chart of, as it were, sources of startup failure. But you're right that that one big slice will be failure to achieve product market fit. A second slice will be falling out with co-founders. And one of the things that I do often with founders and CEOs that I'm coaching is take them through a little questionnaire to assess the health of their co-founder relationships. Because very often these things tend to get ignored until the point where actually there's a problem that can't be fixed. It's interesting, by the way, that the most common equity split between founders is 50-50. And yet, to me, that most indicates that the two founders, if there's two of them, haven't had a difficult conversation about who's adding what value to the business. They preferred to put off.
But perhaps they don't know ahead of time, right? Like even when you're getting started, it's a very easy split. Is like, and the problem is, what if you start like that, and then like 6 months in, you realize that it actually shouldn't be that. It's really hard to redress later. Because often ex ante you don't know. You may not even know who should be the CEO up front. I think in your book you suggest sometimes you should. It's not a bad idea to wait until you see who is best suited for the task.
I think that's exactly right, and it's interesting that not many founders are comfortable with the idea of renegotiating the original founder split. But one of the greatest sources of dissatisfaction that I see between co-founders is when one co-founder kind of feels like they're carrying all the weight of the company, and that the other person is kind of a passenger or a free rider. And that dissatisfaction, if left for a long time, will fester and become very problematic. And it's actually perfectly possible that it could have been easily sold by switching the split from 50-50 to 60-40.
Yeah.
And then the person who's staying a bit later and working a bit harder and raising all the money and hiring all the people will feel less sad. But so that's the co-founder thing. I think that actually, in a way, that the difficult bits that I'm most interested in and I'm most exposed to when coaching CEOs are about the kinds of pitfalls that come up when you've suddenly got another $2 to $10 million in your bank account than you had last week.
Is that when
Um,
people typically
and you
hire
know,
you? So it's after they've raised a Series A, and all of a sudden they have this money and they don't necessarily know what to do with it.
yeah, I mean, well, given the escalation in transaction sizes, 2 to 10 can be a
Yeah.
seed as well as an
Yes.
A.
True.
But I think that's about the ballpark amount of money. Yeah, and I think it often happens because you raise a load of money, having presented a beautiful slide deck to investors, promising all kinds of exciting stuff you're going to do, and then you start feeling immense pressure from your board, from your investors, to make good on those promises. Now, particularly if you have the product market fit problem, and that was the slice of the pie that we talked about earlier, you may find that squirting more money down the marketing channel doesn't produce the hoped for increase in sales that you had forecast. The one thing that you can do very often is to bulk out the team,
Mm.
is to hire a load of people. And so it's surprisingly common that founders, with the active encouragement of their VCs, will hire in a load of senior people, and they'll do it often in a bit of a hurry, and often not very thoughtfully, and that can produce 6 to 9 months down the line some real
Is your
pain.
recommendation to
If you
only
just,
hire once it hurts, or not necessarily?
I think it's a very complex and subtle issue. Um, I think one point is that a useful approach is often to identify for yourself as founder or CEO and for the people who report to you what are the lowest value parts of your working day that you can most easily recruit to replace. That's a very economic
Mm.
focused way of hiring to build a business, because then what that means is that you're hiring relatively low cost people and you're liberating large amounts of time from the people at the top by taking out the most easily delegated pieces. And this is often a problem in B2B SaaS. Very often, you want to have more seasoned, more serious, more seasoned people in order to be able to make the business grow faster. And for that, the ideal thing to do is not necessarily to wait, but to try and bring in those people who you think can help you get to the next level.
Yeah, no.
The
Our experience in
difficulty,
B2B SaaS is if you come from the industry or either as a founder or that you're head of sales, and you're going to the level of credibility and your ability to get sales increases so much more dramatically than if you're just like young, hungry, and smart. But you need people to change their behavior, and so I totally agree with that.
yes, and the challenge there is that particularly for young founders, you often meet some kind of serious, experienced-looking person who kind of intimidates you and almost like feels like your boss or like your
Mm.
parent or something like. And you think, well, if they intimidated me, that must mean that they're going to do a great job. Um, and sometimes that turns out to be exactly right. Sometimes they make your company much more serious and much more credible than it would have been, and they put in place processes that are hugely valuable. Other times, what you discover is that the person that you hired was, in fact, on a career track that was kind of plateauing off, and they weren't succeeding in the big company with the famous name that you hired them from. Um, and their skills are kind of a little bit rusty, and that you discover you know a whole load of stuff that they don't know. They're not even able to use the basic tools of your business. So, you've got to assign someone to show them how to use Slack or how to deal with their email or stuff like that. And they have a kind of slightly bureaucratic, slightly big company
But how can you
mindset.
tell the difference between the two of those? Because one is
Well,
fantastic
the
and the other one
fascinating,
is
the
horrible.
fascinating Yeah, it's true. And the fascinating thing is, so when I'm working with CEOs, we talk in detail about the hiring process and how to have a rigorous hiring process, how to resist the temptation and the pressure from your investors to hire super fast and to hire off the brand name of a most recent employer, or to hire off a strong personal recommendation from one individual. And if you've got the right rigorous process, then you can filter for these things.
Okay.
But here's the scary bit. when people hire with the wrong process, it commonly takes quite a while for the problem to emerge. And the reason it takes a while is because your first reaction when you've got somebody into your company who's 15 years older than you and 10 times as experienced at the particular part of the business that they're running, that you're thinking, this was a pain point for me. It was a hassle for me trying to solve this. I'm so glad I have this person who's solving it instead. I'll just leave them to get on with it for a while. And then I'll check in with them in 3 months, or we'll have a review in 6 months to see how
So it
things are
actually
going.
goes back to the first thing about managing teams, especially managing more senior
That's right.
people.
And then what will happen is there'll be a few kind of straws in the wind that will cause you to doubt maybe this person isn't quite as fantastic as I thought they were. And then it will often take a few months before you really begin to start saying, hey, so what actually have you done here? Let's take a look at what you've achieved. And it's surprisingly common for senior hires that don't work out to take 6, 9, even 12 months before the founders are ready to admit to their board that I made a mistake and we need to hire somebody else.
Yeah.
The cost of it can be massive.
I keep having these weekly meetings and following the scrim, I guess the way we describe it, protocol, and you can probably figure it out earlier. I agree. I think like fire fast, and if you have usually a doubt that something's going to work out, that doubt is right. Like I think people never fire fast enough.
Yes, yeah. I used to say often to CEOs that if you're thinking about firing somebody, it means you should have done it 3 months ago.
I totally agree. Actually, I want to circle back for a quick second on something you said of the co-founders. When one co-founder thinks they're bearing more of the weight than the other, is it typically true? Because it could just very well be that the other one is working really hard, but they don't necessarily see the work that they're doing. So, or maybe all they need is like I don't know, like couples therapy, where they actually tell each other what's on their mind, and they just don't do it. Because these are difficult conversations to have. Or do you think it's typically true? Like, the instinct they have is the correct one? Or it depends.
I mean, apparently there's been some interesting research about people in a domestic setting, which shows that couples living together, if they are asked what percentage of the domestic chores do you do, it's very common that the two numbers, when added together, come to a great deal more than 100%.
Exactly.
I think I do 70% of the washing up. You think you do 60% of the washing. Total 130%. So something not quite right there. And you're absolutely right that between founders, if we're both working incredibly hard and we're not seeing the other guy doing it, it's possible that we might miss all the hard work we're putting in. But I think sometimes there's a mismatch of personal circumstances. So I've seen difficulties, for example, between two founders where one has a partner and the other doesn't. And the one with the partner is saying, come on, I'm going out to dinner. We're going to do something fun. We're going to the park tomorrow. It's the weekend. And the first founder is saying, hell no, I'm in the office sorting out some problem. There's also issues about working preferences. Some founders are early birds and love being in the office for 2 hours of blissful silence between 7 a.m. and 9 a.m. Others like to show up and crack open their first cappuccino at 11, but they're still very happy working late at night. What are your hours, by the way?
I'm in the second category. I like if I can start at 10 a.m. That's perfect. I mean, sadly these days I'm overworked, so I'm often taking calls at 8 or 9. But my ideal is I wake up at 9:43 for a 10 a.m. first call, and then I'm back to back, and I'm happy to work as late as possible as needed. But yeah, I am not a morning person.
Well, there you are. And, it is surprisingly common that you have two founders who've never actually sat down and talked with each other about the fact that, one of them thinks the other one is a slacker because they're starting late, and the other one thinks the first one is a slacker because they're leaving early, in quote marks.
But by the way, most startups, I think, are on my schedule, because most of the programmers, most of the employees are rather young, and I don't know. I've noticed that they 10 a.m. is kind of like the start time for most startups that I've ever been involved with. And so it was always aligned with my personal schedule more than others.
Yes, I think it's kind of one of the founder's privileges. Like the other founder privilege in pre-pandemic days when everybody came to an office was choosing where the office location is. And the answer is if I'm starting the company, the office is going to be in the place that's most convenient for me, not for the 50 people I have not hired yet. But hours, I suppose, working hours is probably just the kind of the least of it. I think partly it's about karmic strain, that it sometimes will emerge that one founder kind of feels that they're bearing the emotional weight of thinking about, is this company going to succeed and what do we need to do to keep it
I see.
alive? Um, there's also a question about inside and outside, that a founder who's not visible to investors and not visible to customers, but is making sure that the trains run on time, is often less appreciated than the outside founder. And it can sometimes be the case that the outer facing founder feels, I'm the person who's the public face of this company and I really deserve to be better compensated. So, I mean, to sum up, what I'd say is that most of these difficulties
Yeah.
can be accommodated with the right kind of dialogue between founders, and that's something which I've facilitated a few times. And they can be solved partly by renegotiation, as I described, partly by behavioral change. There can sometimes be things that one founder is doing that the other founder finds kind of irritating. And also partly they can just be solved by exit. It sounds extreme, but there's some people whose destiny is to stay with one company for 10 years until it becomes a decacorn or bigger. And there's other people whose destiny is to
Yeah.
start stuff and then move on. And there is no shame in being the kind of founder who's great at having a fantastic idea, raising some money, building an MVP, taking a company to 50 or 100 employees, and then moving on and doing it
I actually
again.
want to come back to that in
And
a
there's no
top.
reason why the two founders have to stay the same length
I
of
want to come
time.
back to that in a second. The way I've sold, by the way, the problem is something you don't advise, which is I've done co-CEO things, but it's co-CEOs with different tasks. So I was always the external facing to both the press, the public, and the investors, frankly, but also running product. And my co-founder, if you want, had the internal making sure everything worked and the trains were on time. Kind of a COO role, but just as involved in like strategic decision making as we, which is why we called it co-CEO. And for us, it worked really well. And frankly, even at FJ Labs, which is a startup in its own right, we didn't join a fund, we created a fund. I have a partner, and he does all the back office. Frankly, all the things I hate doing, like raising money from LPs, reporting to LPs, doing all the legal work and the structuring, etc. And for a while, I was like, I sometimes feel I create more value, but I think it's a feeling. I'm not sure it's the reality, and that's why because I'm the one like often pushing and making the decisions around investing. But frankly, I'm not sure I would have a fund if it wasn't for him doing all the stuff I hate doing. And so actually, I think these types of partnerships seem to work, reasonably well.
Yes, and it's funny, I know from talking to Jose about
Yeah.
these things that he would not want to be the
Yeah.
front man, the famous person, the blogger, the podcaster,
Yeah.
and so on. I think that it is actually a possible and sustainable strategy to have co-CEOs with an enormous but that's very important. Just as I was talking about the risks if you're a CEO of failing to manage people effectively because you're either neglecting them or micromanaging them, the commonest outcome that I see in co-CEO situations is that you have a kind of division of territory. I'll do product, you do marketing, I'll be outside, you be inside, whatever. And that the two co-founders then think, well, look, that's her territory. I shouldn't be getting
Hmm.
involved there. I shouldn't be interfering. I should just let her get on with her stuff. And I think that is very often a missed opportunity because it's in the nature of founders that we all have weaknesses and we all have gaps. And one of the reasons that many VCs prefer to fund companies with two founders than companies with one founder is that they hope that for any given flaw or failing of one of the founders, the other one will help to correct it. And if you're in a co-CEO situation, but you've divided up the territory so comprehensively that you say, well, marketing, not my department, I'm going to let you make all the decisions and I'm never going to question any of your decisions, you're missing something.
Totally
And
agree.
therefore the
No,
implication,
totally agree. You should check in and because you can provide insights that they don't have, or even if it's their core expertise and they have no one to really check in on. Wait,
well, but let me suggest a rephrase. The problem with check-in is that check-in can often become lazy speak for, we're just going to sit down over a coffee and you're going to tell me all about what's going on and I'm going to smile and say that's fantastic. I would prefer to use the phrase hold to account.
Okay.
And what I would say is, if I'm the outside person and my job is to have reached out to 30 VC funds so that we can make sure our fundraising is on track, then you as my co-founder are allowed to, as my co-CEO, are allowed to say, okay, so how's it going? How many have you
Sure, of
reached out to? Where
course.
are they in the funnel?
No, I think that's a good point. It can't just be you tell me what you're doing and that's it. It has to be held to account. Okay. So
Mm.
switching gears a little bit, what I've often noticed is how ineffective startups boards are. I mean, many founders that I talk to, we are passive investors. We write small checks in a lot of companies. We're not on the board. I mean, except for the companies that we build. And I have like a couple hours of conversation here and there with founders, and they find that those conversations, 95% of the time, are more valuable to them than the conversations that they have at the board level. And to me, that's in a way that's surprising because the boards like see them over time, and so my intuitive answer is, well, maybe because they're worried that the board in a way is potentially judging them, they can fire them, and may want to invest in the next round. So they present like rosy information. Maybe that's the reason, but I'm not sure. Like, why are so many boards like dysfunctional?
Well, I think that's a great question, and it's a question that I've been puzzling over for a while. And I've come up with a number of different answers in different situations that I've observed. So one thing is kind of the point that you just made, which is that the most tempting thing to do if you're a founder or CEO after you've raised money is that when your VC shows up at the board meeting, to wish to reassure them that they did the right thing by giving you their money. And that means that when they ask, how's it going? The answer is great. And pretty much any question you are trying to give, I say trying, you're unconsciously, subconsciously giving them the rosy picture. And I've actually had the experience of observing board meetings of a CEO that I was coaching and realizing that the CEO was not disclosing to the board many of the problems
Hmm.
that he and I were actually talking about in his operational management of the business. But it's not just the CEO's or the founder's fault because,
But do you think they
um,
should really? Because I'm not sure they should
yeah,
actually.
well, exactly. And what I was going to say is you have to be aware that every conversation with an investor is an investment agreement and
Wait,
so
sorry,
on.
we had a little bit of a disconnect. So could you re-go to every conversation with an investor is?
Yeah, every conversation with an investor is an investor relations conversation.
Yeah.
And so if you call one of your board members at 11 o'clock on a Friday night and say, hey, maybe I wasn't really cut out to be a CEO, maybe this company is a stupid idea after all, then if you call them back 5 weeks later and say, we'd like to raise $50 million, then you may find that it's hard for them to forget what you said previously. And so there is a degree of inherent conflict there. But there's also something I think which is important, which is that less experienced CEOs who don't know many VCs often conclude from stuff they read online that venture capitalists are these kind of evil geniuses who sometimes they think their mission is to kind of do me out of my company and take it away from me. Sometimes they think, their mission is to unseat me as CEO and replace me with somebody else. Actually, what I've found is that many VCs are really in doubt and really don't know what the right thing to do is and feel under huge pressure to try to show wisdom and to try to show insight when they may not necessarily have any.
Hmm.
Now, I think at the core of the issue that you're raising, Fabrice, though, is the following. It's that there are probably two things that people expect a board to do. One is to exercise governance and to make strategic decisions. Should we enter the US market? Should we expand into this product line? Um, and to make sure that everything in terms of from a legal and accounting perspective is being done properly. Make sure that nobody's doing something wrong and causing liabilities they shouldn't do. And that's a good set of responsibilities for a board to take on. There's also sometimes an expectation that the board will provide professional development for the CEO, and that the CEO will show up and the board will kind of act like the teacher marking their homework and say, okay, so you did well last month, but here's what you need to fix. Now, in my experience, having been a board member myself on 20 different boards, I find that boards are very rarely the right venue for professional development of a CEO because it's extremely hard to admit to your failings when there's 5 people around the table or 4 people around the table.
And they may be the ones who may want to give you money in the future, and so
Exactly.
you may not want to tell them
The
what your
money.
failings are. But
Um,
so, do you think every CEO should have a coach?
well, I think I don't want to. The thing is that I don't want to sound like I'm, as it were, arguing for my own taste here. But what I've found is that there is an inherent conflict in being an investor and VC at a company, and also thinking that you can proactively help the CEO get better at doing what they do. And I've concluded that in companies where we have an investment, I don't want to um, try to act as a board director where I'm helping the CEO professionally and personally. And that when I have relationships with CEOs where I have no investment and no stake other than I'm a fee compensated, option receiving consultant and advisor to the company, I find it's possible to have deeply personal and practical conversations with CEOs that were never possible when I was an investor.
Are you mostly compensated in options or cash or both?
Both. I
Both.
think the interesting thing is that lots and lots of unsuccessful companies would love to pay advisors in options because 5% of nothing is still nothing. But I think that I'm luckily in the position where I have a lot more demand for my time as a coach than I have available supply.
What percentage of startups out there do you think have coaches? Because I assume it's tiny, or I suspect it's tiny, but you might
Well,
know better, actually.
I would guess if you were asked me to guess randomly, I'd probably
Yes,
say 20%. But I think
20%. Okay.
there's a very important caveat, which is that I think that coaching has become a kind of fashionable thing for startup CEOs. But for many of them, coaching is a little bit like a little bit like an employee perk, like a free
Mm.
gym membership or a company car. And that's partly because there's a lot of people who are coaches who have a PhD in psychology and who are wonderfully good at making you feel good and helping you sort of think through some personal issues. The approach that I take is that I'm being compensated by the company to increase shareholder value. I'm increasing shareholder value by working with the CEO. And that has two important side effects. One is that the benefits to the CEO in terms of greater happiness or better self esteem or whatever will come from succeeding more, not from me trying to just make them more generally happy as a direct objective. And the second thing is that for the process to work, there has to be not just trust, but confidentiality. And so that's why, in my standard terms with companies where I'm coaching the CEO, there's a clause that says even though the company's paying the bill, the other members of the board are not allowed to call me and say,
Mm.
hey, what did Fabrice tell you in his last coaching session? Should we fire him? We're not sure. That's not my role. My role is to take the person I'm working with as I find them and help them do absolutely the best they can.
By the way, I think for the audience, for potential startup founders, I would create a distinction between three roles. The board, of course, which is strategic decisions. You meet them once a quarter or once every 2 months. And two is advisors, which for me are more people that open doors to get sales and not someone who would be in a way your coach. And then three, a coach, which is like, okay, here are the issues you're dealing with, whatever they may be they interpersonal, personal, or how to manage people, how to hire people, etc., or culture. And that's a very specific and different role than the advisor role, which for me is more like opening doors and getting sales or learning best practices and whatever Scrum.
Yeah, I think that's completely true. And I think that there's plenty of smart CEOs who either have a core of advisors, as you've described, or actually who make a point of bringing on a load of angel investors, each of whom has a specific area of expertise, so they can call them. So when they have a problem to do with marketing, they run their finger down the cap table saying, marketing, marketing, marketing. Who's the marketing expert? Oh, yeah, him. I'll call him. Um, and at first sight, that may seem like a perfectly acceptable substitute for a coach. But I'm reminded of Donald Rumsfeld's famous line about the Iraq War, where he talked about the difference between the known unknowns and the unknown unknowns. If you know that you've got a problem with marketing, then you call the person who's the expert in marketing. But it may well be that, not may well be, I find it overwhelmingly common that the biggest challenges that are facing CEOs and the problems that are paradoxically the easiest to fix are often the problems that you're not aware of.
Yeah.
Because if you were aware of them, you're an intelligent and hardworking person and you would already have fixed them. And so, therefore, when I'm working with a CEO as a coach, I will typically alternate between sessions where we're dealing with the challenge du jour, whatever it might be. I had a board meeting last week and it was a bit of a train wreck. How do we deal with it? And then where we're doing proactive kinds of sessions where I'm asking them searching questions about how they do different aspects of the job. And the outcome of those discussions is often to reveal things where they weren't aware that there's a better way than the way that they're following. And my job is not so much to tell them what to do, but to present them with some options. Here's how you might do it differently. Um, and to allow them to examine those options and make decisions. And it's often amazingly refreshing to see how quickly stuff can change when you're able to open those kind of doors.
It's actually good, or that things can really change, and people can really improve, and it like changes the outcome dramatically.
Can I give you a tiny example?
Yeah, absolutely.
So, a CEO I was working with today is under pressure from his board because one of the members of his board thinks that he doesn't care enough about unit economics and profitability and so on. And he's kind of caught, though his board don't realize it, between that pressure from his board on the one hand and a group of people in his team reporting to him who are saying, you're asking me to get more sales for the same price or to use these salary levels but increase the size of my team. But sorry, no can do. And he's kind of caught in the middle. And one of the outcomes of our discussion was to realize that in every startup, there are decisions that you can make about cost where there are serious trade-offs, where if you want to spend money, if you want to spend less money, you're going to get less result. But there are also some areas where you can keep costs under control without having negative side effects. And one of the things that you need to do if you want to run a tight ship is to make sure that all the people who report to you are aware that it matters not just what do they deliver, but can they deliver it cost effectively? Because history shows repeatedly that capital efficient startups do much better than those just that spray money in all directions. And so the way the conversation went was to realize that this particular founder isn't a nickel and dime kind of person who wants to think about lots and lots of tiny detail, and therefore needs to have a CFO in place who is out there talking to the rest of the team and making sure that everybody is trying to make the best use of resources they can. And that interestingly, I think for the CEO, that discussion was hugely liberating and eye-opening because it made him realize that this could well be a solution to the problems that he's facing with his board, where he can reassure them that everything is being done to deploy the capital as effectively as they can without fundamentally having to change himself what he does from day to day.
Yeah, that makes sense. In the interest of time, because I think we're running out of time, so what do you think are the top three things a founder can do to make their company successful? If there is such a thing as top three things.
Yes, it's hard to make it not sound banal. Um, First, find the right market. There's an awful lot of founders who are building products which aren't going to serve enough people or are going to serve people that don't have enough that don't have enough money at their disposal to make a real business. And so that's crucially important. The second is to get the product right. And that's a very early stage issue, but it's surprising how many companies go much further than they ought to in scaling before they have the product right. And I think the third is recognizing that ultimately your ability to scale a business is all about the people and specifically hiring people who can run the business at 10x and 100x the size that it is today. But what that means in turn, in a way, you could boil those three things down, if you're a founder, to simply this, to thinking about the fact that if your company is going to succeed, then in the next 1, 2, 3 years, it's going to be 10 times the size or 100 times the size of what it is today. And to run that company effectively, you're going to need a set of skills, many of which you don't have today. Now, sadly, you don't have the opportunity to kind of quit and go off and do an MBA or go to some special college or something. You have to find a way to acquire the skills while the airplane is still in mid-flight. And that's a deep challenge for founders. But if
Do
you
most
can,
founders realize at some point they probably shouldn't be founders or a new CEO and maybe move to chairman or chief strategy officer, or they have to be told? Because sometimes the founder-led companies are probably the ones that have done the best, right? Like you think of Apple or Amazon or Facebook.
well,
But
exactly. I think that Mark Zuckerberg has done a great disservice to the startup industry as a whole because he has changed the expectations of many founders who think that you can go all the way from dropping out of Harvard to $100 billion corporation and you will scale with the business. My sense is that half the founders on the planet should not stay founder right the way through to the end,
and do you
and
think
they
most
should.
people should drop off when? Is there a clear cutoff? Is the B, the C, the A, the D? Well, probably not the A, but like
It varies. It
it
varies radically
varies.
per person. But the important thing to do is to know what the right point is for you, and that's not just conducive to happiness if you are a founder. It's also conducive to maximizing the value of your own shareholding. And one of the conversations I often have with founders is to remind them you're thinking about this from two perspectives here. One is you have a business card with a job title on it, and you feel a certain pride in that job title. The second is that you are a stockholder, and probably your stake in the business represents your single largest asset by far.
Absolutely.
Are you just going to think about what will preserve your job title, or are you going to think about what will maximize the value of your portfolio?
In Thank you. So actually, in the last minute, uh, how long do you think? When do you think this bubble will burst? Because do you think switching gears and completely changing topic, and literally we have 1 minute. Do you think we're in '98? Do you think we're in '96? Do you think we're like February 2000? Um,
So the answer is I have no idea, and I have mistimed things many times before. And that said, I will answer 6 months. Um, it's not specifically to do with stuff in the in equities. It's not specifically stuff to do with startups. It's just that I see lots and lots of downside risks. I see lots of expectations of a post-pandemic recovery, and I see lots of systemic and structural problems. So I have
okay.
no idea. But this is a moment in which I feel it is good to be cautious. This is a moment when I think it's good to be fearful.
I
There
totally
will be
agree.
a time quite
Totally
soon.
agree, but I think it'll take longer because there's so much capital coming in. 1.9 trillion stimulus, right? Like, and I think and people have been saving so much money. The minute this ends, people will party like there is no tomorrow. It'll be the party to end all parties. And
That's so
I don't
true.
think that's happening in the next 6 months because I think we'll put COVID behind us in the next 6 months. That's
Right.
why I think it'll be longer.
Yeah, I would just say as a warning though that remember when the real economy was tanking in COVID, the stock markets roared ahead. So it's perfectly possible to have the reverse. What's your date, Fabrice? When do you think the party will end?
I'd say next year. And because there's so much the savings rate right now in the US 13%. Historically it's been 7%. If you bring that down, that's 1.3 trillion plus the 1.9 trillion in stimulus, the amount of spending and extra money that's going to come to the market is so high that I think we're still at the early stages of inflating the bubble. I think it's going to get crazier when we're in for a wild ride. And that said, get liquidity, sell, increase savings, be careful. I
Right.
totally agree with that statement.
Well, let's hope that we're both wrong and that things continue to grow sharply as far as the eye can see.
I know. And by the way, it could happen, right? Like we could grow out of this if we finally get the productivity growth that has been in store given because of tech, right? Like you can actually see productivity growth in healthcare, in education, etc. That's the way we decrease the debt levels that we had after the World War One and World War Two. Could
Uh,
happen again, and I would like that to be the outcome.
That's very true, except remember that what everybody said in 2000 was that the economic cycle has been abolished.
I'm not saying it's been abolished. I think there will be
And,
economic
and
cycles,
what,
but
what I'm
if we can grow
suggesting
out of it, it'd be great.
what I'm
Anyway,
suggesting
I
is
need to run to my next meeting, but this was wonderful. Thank you
Fabrice,
for
it's lovely to
joining.
talk to you.
I'll tell everyone, they should buy your book on Amazon. So it's not actually 36 lessons, but it's just called Startup or
It's called Startup: 36 Lessons from Company CEOs and Founders, but it's a not-for-profit project. It's the lowest price that it is allowed to be sold on Amazon.
perfect. And, hire Tim. He's an amazing coach. He's coached many of our CEOs. And I think we've identified why you need a coach. So thank you for joining. And I'm sure we should do this again soon in the coming years.
Thank you for having me. Have a lovely day.
Thank you.